Welcome to the next edition of Pizz-Spectives. My name is Rob Pizzichetta, founder of Mont Wealth. And today I want to talk to you about life stages. Now, plenty of the conversations we're having more recently is around cost of living, concerns, am I going to be able to retire comfortably? So I want to talk through where you're at in your 30s, your 40s, your 50s, 60s, 70s, and beyond. So today's discussion, firstly, as a population, we are getting older. 2, the different stages of our life cycle requires different strategies. 3, why maximizing super for both returns and contributions provides you a financially comfortable retirement. Now, I use the term financially comfortable, which means buying what you want, when you want it, without being concerned about monies. And then finally, why $2 million plus in your individual super account and or $10,000 per month of income in 20 years is required. So let's have a look at the Gen Xers and Millennials. These are the ones feeling the pressure the most at the moment, and we're all feeling your pain. So we're here to help educate that things will be all right, and there are life stages that we all go through. There is a cost of living crisis, which is squeezing Australians at the moment, and predominantly the 30 to 50-year-olds are experiencing mortgage stress, or becoming prisoners, and also rental costs are rising for those renters out there. The other thing that we're going to be mindful of is government indebtedness is leading to increased wealth tax. So for the baby boomers, however, superannuation balances are at all-time highs and retirees are benefiting from previous wealth creation in property and generating higher income from cash and bonds, which they didn't experience from the years of 2010 to 2020. So what are the different life stages? So for those in their 30s, you're in accumulation mode. It's all about saving and planning for the future. Now, you may have a mortgage, you've probably got young children, and you're experiencing a rising cost of living. So you need to ensure that you're maximizing your super returns now. Make sure you've got the right allocation. Now, it's got to be at a minimum balance to growth because you've got 30 to 35 years before you even retire. So do seek advice from someone, but go and seek advice from someone about how to best structure your superannuation to maximize your returns. Also, ensure you have life insurance and income protection out, as well as trauma. Now, this is very important, especially if you have mortgage. Now, so many people are underinsured in life. It scares me. They sit on their default at their retail super fund, their industry fund. Now, you've got to make sure that you can protect and cover your mortgage, pay for your children's education, and hopefully support your partner or spouse that they could live comfortably thereafter as well. And income protection and trauma protection can cover you in case of emergencies. Also, make sure you refinance your mortgage. Have a look at that. You're getting the right deals. And if you can, accelerate your savings while living costs are lower. Now, trust me, as you get older into your 40s, your costs do accelerate and rise as your kids get older. And so maybe start building up a bit of a buffer in your offset account or start considering some investments outside of super. Now, if I have a look here and talking about the importance of maximizing your returns in your 30s. Now, I compare to those looking on YouTube now, you can see this chart. There are two 30-year-olds with $75,000 in super. One invests at 8% return, so higher risk and growth, versus 6% return for a balanced and conservative individual. Now, the difference in 30 years or 32 years, if you started in your 30s and retire at 60, 65, is $1.2 million, all because of 2% difference return per annum over that 30-year period. So something to be mindful of and be aware of maybe your risk aversion to consider and go and seek advice on best how to structure your superannuation. Now, the next stage is for those in their 40s. Now, you probably feel like you're on a treadmill at the moment, and there are many of us in the 40s that are probably feeling that way. We've got mortgage, we've got school fees, we've got teenagers that are more expensive or young adults, and life. Cost of living for the 40-year-old is at its highest. Now, if you can, consider some investments outside of super to provide some flexibility. For example, saving for travel, or accelerate the mortgage repayment and build that offset account, focus on the kids' futures, but also utilize that offset, as I said earlier. If you can, look to maximize your contributions and returns to build wealth. This is in superannuation. Now, remember, superannuation is the most tax-effective retirement vehicle. I'll say that again. Super is the most tax-effective retirement vehicle. Once you get to $1.9 million in superannuation, the income you can generate from that is tax-free. I really want you to consider that and remember that. please go and seek tax or financial advice on that. Now, in your mid-40s, your super balance should be around $250,000 to $400,000 if you are targeting that financially comfortable retirement. So have a look at your balance, see if you're there. If you're not, then come and see me or speak to a financial advisor, and we can discuss how we can accelerate to get there. And then finally, make sure you've got life insurance and income protection. Again, we've covered this earlier for the 30-year-olds, but this is just as important in your 40s. Life insurance to cover the mortgage, the kids' needs, income protection and trauma cover. Make sure that your will is up to date, even for the 30-year-olds. Guardianship. Who looks after the kids if something were to happen to you? Now, for those in their 50s, it's time to accelerate your wealth creation. Now, you may be at the end of maybe a mortgage, or that's probably 5 or 10 years away from paying that off, and you're probably coming towards the end of school fees. Cost of living starts to decline finally, and you should be planning to retire in 10 to 15 years. Now, this is where you should be looking to increase your super contributions or growing investments outside of super. Remember, super is still the most attractive vehicle. Now, for the people in their mid-50s, superannuation balance should be around $750,000 to $1 million. Now, at 55, you should also consider the downsizer contribution to accelerate retirement planning. Now, the way that the downsizer contribution works is you and your spouse can both contribute $300,000 each, but you do need to be over the age of 55. You need to have owned the home for more than 10 years, and you need to contribute within 90 days of settlement. Now, again, go and seek financial advice on that. Now, wills, life insurance, and income protection are still important, but always worth reviewing as circumstances do change. The other thing that need to be considering in your 50s and maybe even in your early 60s is that your parents are aging and some care may or is required. Unless they can self-fund aged care, you may need to find capital to support their needs. So something to be mindful of there. Now, for those in their 60s, it's all about super contributions. Again, let's think about that vehicle, most tax-effective vehicle for retirement. So it's a bit more of a focus as we retire on capital preservation and income generation. So for those in their 60s, if you plan properly in your 30s, 40s, and 50s, then that planning and discipline has paid off. Now, you may be in retirement in your 60s, or you may be planning to soon retire, and that depends on your lifestyle choices, how much income you need in your retirement. At the age of about 60, you probably need, in my opinion, 1.25 to 1.75 million to then get to that super number of $2 million plus. And that's where we believe that you need to be financially comfortable. Now, remember, financially comfortable to us means to be able to buy things when you want without being concerned about whether you can afford it or not. Now, yes, this is achievable for anyone in their 30s, 40s, or 50s. It can be done. Now, we need to maximize your super contributions if you haven't yet retired, or even if you have, which is currently $120,000 non-concessional contribution per annum, or $360,000 as a 3-year bring forward. Now, we can discuss that if you would like to learn more about that. Now, again, account-based pensions are currently tax-free up to $1.9 million. Now, these are indexed, so as we get older and as time passes, that number will rise towards 2 to 2.5 million for those Gen Xers and Millennials. And any amount above the 1.9 million sits in your accumulation account, which is taxed at 15% on the income and gains, but discounted at 10% if you've owned the asset for more than 12 months, like CGT and other assets. Now, we should also continue to consider estate planning strategies if you haven't already. Things like testamentary trusts help protect your wealth creation. So in your 70s, it's all about capital preservation and income generation. You can be enjoying retirement here. Consider estate planning strategies and also considering allocating capital towards funding aged care. Now, if we've planned properly from the 30s, 40s, and 50s, you should have enough funding in your superannuation accounts to be able to fund your retirement. Now, there's been a great article written by Bernard Salt, who's a leading Australian demographist in the Australia. There's a link there on the YouTube, and I'll make sure it's on the podcast as well. He talks about the life stages of those that are plus 55 cohorts. Now, this is what gets me excited about working and planning towards retirement. The lifestylers are the 55 to 64-year-olds. The active retirees are 65 to 78. The wind downers are 79 to 88. And the frail elderlies, as he called the frailderlies, at 89 plus. Now, remember, Bernard Salt created the term smashed. And what Bernard does say is often well read and understood. So we're getting excited for our clients that are in that lifestyle stage of 55 to 64 and the active retirees are 65 to 78. It's a very enjoyable period of life. And we're really looking forward to sharing that with many of our partners. What, however, is interesting, as Bernard highlights too, though, is that if you look back to 1950, there was about 8% of the population over the age of 65. Now, fast forward to today, it's probably 18 to 20%. And by the time I retire in 20 years' time, that'll be close to 25%. And then by the time that my kids retire, it'll be closer to 30 to 35% over the age of 65. So we are getting older as a population, but we are also living longer. So it's very important to maximize those returns in super. And this is why we say we are living longer. So recall the pair, the two 30-year-olds with 75,000 in super, the one invested at 8% return and the other generated 6% return because they're a little bit more risk aware and conscious. So they generated $1.2 million less than their super balance. So they got them to 2.3 versus the person who took a little bit more risk or was aware and educated themselves about finding the right advisor and got themselves to 3.5. Now, so why is $2 million plus super the magic number per person? If you can see by this diagram, and I'll explain this over for the podcast listeners, $2.5 million allows your balance to grow while you still can generate $10,000 of income per month. Then by the time you get to the age of 80 and you need to fund your aged care and draw down $1 million, your balance goes from over 4.2 to below $3.5 million to fund that. So 4.2 to 3.2. But because you're drawing down less than what you actually require, your balance continues to grow. Therefore, you can leave a legacy for your next generation if so wanting. Now, for those that retire at $2 million, again, draw down $10,000 of income per month, decide to go into aged care at the age of 80, then take out $1 million, then your balance goes from 2.8 to 1.8, and your balance stabilizes thereafter. So that's the magic number above 2. However, if you retire with 1.5, $10,000 of income, at the age of 80, draw down $1 million to fund aged care. By the time you get to 84, you've run out of money. Now, that's just a perfect example as to why we need to maximize our returns in superannuation. The magic number is north of $2 million per individual in super. Now, why is 10,000 income per month the magic number? That's because today's $6,000 per month at a 3% inflation rate equates to more than $10,000 per month in 20 years. In fact, in 20 years, it works out to be $10,521. It's very important that we're aware of what inflation impact does have on the power of money looking forward. So financial advice is more than just returns, as the cost of not seeking advice can be detrimental in your retirement. You need to consider how to fund your lifestyle and how to fund your aged care requirements. My name is Rob Pizzichetta, founder of Mont Wealth, and my details are there. I can be emailed at rob@montwealth.com.au. Hope you have a great day.